Evaluating an investment's performance is a little bit like judging the food at a restaurant. You need to keep things in context to be a good judge. A Spanish tapas bar is different from a chicken wings joint. You need to understand your investment's peer group and characteristics to be a good judge.
It's funny, but when I meet complete strangers sometimes and they find out that I'm a financial advisor, they'll start peppering me with questions. And one of those is often, well, I got 5% on my investments last year. Is that a good rate of return? And of course, I'll have no other context with anything in their life or how they invested or what it looked like over the course of a year or what have you. And so I'll always say, I don't know. We need to talk about other things before we could even come to an idea of whether that might be a good rate of return. So today, we'll talk about what are those other things that we need to be thinking about. And we'll key in on 5 different things. First, the asset class, which kind of governs all of this discussion and will inform the other 4. But what is the asset class? How are the investments put into place? We'll talk about the liquidity. We'll talk about the volatility of the investment. We'll talk about comparing those returns ultimately, and then the tax side of things, because it's not just what you can gain from the investment. It is after tax, what do you net that you can use from that particular investment? So lots to dive into today. So Austin, you want to kick us off with that first one, asset class. How do we think about the asset class for an investment?
Yeah, absolutely. Well, you think about the different types of assets that we can invest into. You've got stocks, you've got bonds, you've got real estate, commodities, other alternatives. There are a wide array of things. And so we'll talk about this in comparison to liquidity and volatility. But the reality is, I would hope that stocks over a long period of time are going to get a better rate of return than bonds. Historically, that's been the case. But it's not always going to happen. But if you say, okay, well, I am invested 100% in stocks versus somebody who's invested 100% in bonds, you would expect that rate of return to be different. And so going back to that example, if someone just says, I made 5% last year, well, if they are broadly invested in stocks and bonds, maybe stocks were up, bonds were down, or bonds were up and stocks were down, maybe it is a good rate of return. But again, without a comprehensive understanding, you can't just say, yeah, that was a great rate of return, or no, that was not a great rate of return. And so we also have to remember that each asset class has its particular day in the sun. There's going to be some years where bonds do better. We think about the COVID lockdown and the subsequent recovery. The lockdown, stocks dropped 30%, but US Treasuries did pretty well during that period of time. Stocks then obviously went on a bull run for the next couple months and did much better than their bond counterparts. So we can't always say with any sort of certainty that any percent rate of return is going to be good or bad, because it's within the context of that financial plan. How does it compare to others in that asset class? So next, let's talk about liquidity. You want to walk us through liquidity considerations?
Well, we think about that first part, which is, am I an owner or am I a lender? So you own a stock, you own real estate, you own a commodity. You lend if you're a bondholder, and those are very different experiences. Typically, the volatility, even the rate of return can be different. But one of those that's not appreciated by clients sometimes is the liquidity that we actually have from these investments. Because if we have a very, very liquid investment, then oftentimes our rate of return long-term may not be quite as strong as if we have an illiquid investment. Because usually if you know that you have to have an illiquid investment, if you're putting funds in and you know that you can't get to it for a number of years or you're not planning to, then that illiquidity would mean that you would require or expect a higher rate of return there. Now, that doesn't always happen, but illiquidity can happen both on the ownership side of things. If you own a stock, you own real estate. Sometimes you can make investments where you can't trade them on a day-to-day basis. You can own shares of a private company, maybe that don't trade day-to-day. You can own real estate. You buy a home, and if your home is like my home, I'm not going to be able to sell my home in 24 hours. Yeah. Whereas if we own a publicly traded stock, any day that the stock market is open, we can ostensibly be able to trade that stock and sell it and hopefully garner resources for that. So that's on the ownership side of things, but it's the same on the debt side of things. And a lot of people don't appreciate this either. We can lend on a private level there. And if we make corporate direct loans, for instance, then that asset class is not as liquid as, say, a publicly traded bond. So we might only be able to tap into those resources every so often. It might be every 3 months, or it might even be less liquid than that. But oftentimes those loans pay us a higher interest rate. So we are being compensated in some of those situations by, again, potentially a higher rate of return because of that illiquidity. So we have to be able to say, how quickly can I tap into these resources if I need to? Of course, we're never going to advocate that a client has all of their resources illiquid, because we never know when we might need to tap into some resources. But oftentimes those illiquid resources, again, they can give us a better rate of return in some kinds of market environments. So that is one of the key pieces, again, on the ownership side and on the debt side of things.
Right. Well, when we think about real estate too, oftentimes people will tell us that they're making a great amount of money on real estate, buying and selling, flipping properties. Well, if you did, maybe let's say you doubled your rate of return. Maybe you bought a property for $50,000, sold it a year later for $100,000. But you put $40,000 worth of work in with labor and materials. Well, then your rate of return is only that $10,000 that you gained because you put in the time and sweat equity to get there.
Right.
So we have to think about that kind of constraint as well. Is this an investment like privately held real estate where you are putting in time and energy and effort, your finances on the line as you are doing these renovations to then make it that rate of return that you're actually bragging about?
Right, right. So if you have, to make it really granular, you have a $500,000 investment that you put there, and you put in an entire year's worth of work. I mean, I was talking with a friend one time that he had a far lesser investment. I think he had $50,000 in a property. He spent his entire year, working on that property. He was so excited that he sold it for $100,000, which is great. But he spent the greater part of that year investing his sweat equity, to your point. And I was happy that he had the return that he did. But again, if you put in $50,000 of sweat equity, was your return really that great if you started with $50,000 there? Because he probably easily could have made $50,000 if he was working a different job, from that. So we have to factor that piece in particular with respect to real estate.
Yeah. So let's move on to volatility. The reality here is you got to be ready for a certain ride. If you are invested in the stock market, there could be a year where it goes up 30%. There could also be a year where you go down 40%. And so just like that liquidity constraint, we don't want to be selling stocks when they've dropped by 40%. We want to be able to ride it out, let the stock market recover, so that when those times are, when we do see those nice runs, now we can reposition, get back a little bit more conservative. But we don't want to be selling when we've seen a big drawdown. Similarly, just like in 2022, we saw stocks and bonds both drop. Now, interest rates rose and we're getting paid better on the bond side. But the reality is most of the time over the course of history that we have recorded, bonds have not dropped 13% in a year like they did in 2022. Most of the time, they're slow and steady as she goes, paying a regular interest rate. And if you held those bonds to maturity, you're not going to see that loss in value. But the reality is there is going to be ups and downs in your investment. And it's how much can you stomach, but also with the goals that you have, what are those distribution needs that you have in the near term and the long term? And so maybe, let's say you're a young investor and you can deal with a longer time horizon. Maybe you're going to be invested for the next 20, 30, 40 years. You don't need to draw those funds. Well, okay, maybe a 15% rate of return one year and then a -5 the next year and then a positive 30 the next year. Maybe you can stomach that. But if I need to tap into those resources for living distributions, that volatility is something that I don't want to stomach. And so really we need to think about what is that risk-adjusted return? What are those trade-offs that I'm taking with those more volatile assets? Is it worth it?
Well, and even for younger investors, let's just say one of your goals is to purchase a home. And you go into the COVID lockdown experience. If you have those resources sitting in cash, sitting in a money market account that does not go down, well, now you have an opportunity to use those resources and buy a home potentially on the cheap over the next couple of months. If you have those resources instead, to your point, in stocks, and they drop 30%, well, now you're going to say, do I want to sell these stocks just so I can buy this home and maybe the home's at a discount or what have you? Now you've got a conundrum. So anything that's in the next 12 to 18 months as an expense, we oftentimes want to hold those resources in a very, very secure area, even if we're younger.
Yeah. Well, and we think even too about parallel stock funds. Let's say one stock fund gives you a 10% rate of return, but it's twice as volatile. And you've got another one that gives you a 9.5% rate of return. Are you willing to stomach the double amount of volatility for a 0.5% of return.
Mhm.
A lot of time, we don't like seeing our money drop. Oftentimes, studies show that it hurts way more to see our assets go down. So if you're seeing a lot more volatility,
Mhm.
maybe you just need to say, I'm invested for the long term here,
Mhm.
and I can stomach a little bit,
Mhm.
but is it worth that 0.5%? You really have to ask that question.
Well, and that's where we come back to Warren Buffett's guidance. There's 2 rules of investment. The first rule is don't lose money. Second rule is don't forget the first rule. The last thing that we want to do is when stocks go on sale is to be tempted to sell stocks into that sale.
Mhm.
We want to be in a position, if anything, that we can buy stocks when they go on sale. And to be able to do that, we have to have a level of discipline. We have to know where our expenses are going to be paid from, whether that's cash flow coming in or whether we need to be able to sell some investments that maybe need to be a little bit more conservative on a quarter-to-quarter basis if we're in retirement.
Yeah. And so we'll just take a quick look and understand some of those different asset classes volatilities.
Mm-hmm.
So over the course of history, 30-day US Treasuries may have a volatility of around 1%. They're not going to move around substantially because they're turning over every 30 days.
Right.
US bonds might have a volatility maybe closer to 5%, whereas US stocks might have a volatility closer to 17%.
Mhm.
So just know as you're going into these investments, you need to be prepared as you make those investments. So let's talk about comparing rates of return. So you want to talk us through this one a little bit, Spencer?
Yeah, so we want to think about rates of return with respect to the peer group. Again, if we have US stocks as where the mutual fund or where an ETF might be focused on investments and have their investments, then it's fair to compare that to the broad US stock market or to the subset of US stocks that the manager really has to choose from there. We don't want to be comparing necessarily large US companies to small Chinese companies because their geographies are different, their size of companies are different, even their market conditions are different because of how they're situated and the different types of companies there. So we want to compare within reasonable limits of kind of a peer group there. We also want to recognize that the less diversified a portfolio is, the higher the likelihood that it will have volatile periods. So if you invest only in 1 or 2 stocks, then your portfolio is probably going to be far more volatile, and those returns are going to be far more volatile than if we have a portfolio, and let's just say you invest in an index fund that is invested across the entire US stock market or something close to it. So we have to be careful about the way that we compare, because even if we see a period over the last 3, 5, 10 years where a manager has had volatility in line with the market and has had returns in line with the market, if he or she only has 3 investments in their portfolio, 3 stocks in their portfolio, we need to take that performance in the past with a grain of salt. So we need to be very careful as we compare. One of those things, of course, is the asset class overall. Are we comparing apples to apples? A second thing is, does it really make sense why we're comparing these two? Because if we have one that's far more diversified than another, then we might look to the future and say, well, there's a higher likelihood that we'll see some blips on the radar screen that are unexpected here in terms of the outcomes.
Right. I think the other thing we have to take into consideration, especially as you look at active management, there are going to be reasons why someone might choose an active manager versus a diversified portfolio. Let's say you are highly concerned about climate change or social justice or some other thing, biblically responsible investing. You might choose a manager that's going to have natural volatility that may be more in line with a more aggressive investment, but there may be a reason, a philosophical reason why you're taking that. And so you just really have to notice, okay, am I making this investment for a long-term return, or is it long-term return plus these other philosophical things? And if you're going to go that route, just know that there's likely going to be a higher level of volatility. But there may be a reason why you're choosing to go that path versus a broader diversification that may have less movement. So in that vein, there may be some times where you say, oh, my friend is getting this high rate of return. Do I need to be investing like he is? How do we adjust with fear of missing out?
Well, it comes back to, again, where are we investing asset class wise? Because if we think about the volatility, for instance, that we just talked about, 1% for 30-day treasury bills on average, something like 5% as an average over a long period of time on US bonds and 17% on stocks. the volatility is 3 times more or even higher level with stocks versus bonds, and probably 15 to 20 times higher stocks versus money market funds there. So, or 30-day Treasury bills. So we have to keep these things in mind. But as we think about those rates of return, we want to make sure that we also understand what those long-term averages, have been. And if we have, all of our investments in stocks, then an average rate of return in the U.S. stock market, say over the last 100 years, has been about 9%. If we look at U.S. bonds, it's been a little over half that, something like 5%. If we look at 30-day Treasury bills, so the shortest of U.S. Treasuries there, it's been about 3%. So as we take on more volatility, historically, we've also had a higher rate of return that helps compensate us. But if history is any guide, about once every 5 years, we're going to see the stock market drop 20% or more. So we have to be ready to stomach getting our financial statement, if we're invested in stocks, and seeing that it's dropped substantially for reasons that are always new. The global financial crisis, of 2008 and 2009, people said, we've never seen anything like this. And then, of course, the flash crash comes a couple years later. We've never seen anything like this. And then several years later, we have, some issues with the oil industry. We've never seen anything like this. And then, so on and so forth. We get up to, of course, the pandemic, and then we see the, drop in 2022. There's never anything like it. It's always new. Now, it will rhyme with history, but there's always a rationale that's going to be pushing us to sell those resources when they're down, because we have this fear. What we don't want to do is let our fear of missing out on the way up incline us to be more aggressive than we really need to be or really should be, and then get to a point where we are enticed to sell out at a market downturn, because that is the surefire way that we can have a poor rate of return on investments, is that we buy at high points and sell at low points.
Right. Okay, so the last piece that we want to touch on here is the tax efficiency of an investment. And this really is more for those non-qualified accounts, the ones that accrue dividends and capital gains that you have to pay tax on an annual basis. And so you think about it, you receive money from your paycheck, you say, I want to invest this, you go open a stock or a brokerage account at your custodian, you put that money in, it pays a dividend, you've got to pay tax on that dividend every year. So let's talk about some of the tax efficiency and where that affects a rate of return.
Well, it's important to recognize that we do have tax, and there is a headwind here, because if we invest in, and let's just say we had 2 different options, and let's say that each is going to give us hypothetically an 8% rate of return over the next year, but one is in a real estate investment trust, and it gives us an 8% rate of return. Let's just say all of this is taxed as ordinary income. Well, if we're, again, doing simple math here, and let's say you had a 25% tax bracket there, then your 8%, you've got to pay tax such that your net rate of return might just be 6%, there. On the other side of things, let's just say in this hypothetical 8% rate of return, let's just say it was all capital gains. Now, that's going to be unusual, but again, just for the sake of this argument, it's all capital gains. Let's just say that you knew you could invest in a series of firms like Berkshire Hathaway, Warren Buffett's firm, and they don't pay out dividends, typically. Their gain comes from capital gain typically. So let's just say that you had that 8% rate of return, it's all capital gain, and so you're not paying any tax necessarily in that particular year. Let's just say that happens for many years going forward. You run it forward 10 years and then you pass away. Well, under current tax law, there's a step up in cost basis that accrues to your beneficiaries. So even though there was a lot of capital gain and it was unharvested, and if you had sold it a day before your death, you would have had to pay capital gains tax on that. You pass away and there's a step up in cost basis. Let's just say through that whole 10 years, you had invested in that same REIT, and you got, instead of an 8% hypothetical rate of return, you got a net 6% hypothetical rate of return. Well, that's pretty substantial. Yeah. That's, a quarter of the overall return is sacrificed because of the tax circumstances there. Now, that's an extreme example, but it's not actually all that unusual, because we will see oftentimes that if we have a stock fund that is maybe an ETF or maybe a very low turnover fund that might be a mutual fund, the dividends that are paid by the fund might be the only tax piece that a client has to be aware of, whereas there are other funds that might be actively managed and turned over very, very substantially that every year, let's just say, again, we have, let's say in this example, we have 10% rate of return over here. We have a 10% rate of return over on this side. Well, if it's turned over, if that portfolio is turned over the entire year and all of that gain becomes short-term capital gains, and you're paying ordinary income tax on that, you might be paying between state and local taxes and along with federal taxes, you could pay a third or even 40% of that gain to the government. Whereas on the other side of things, again, you have some dividend income that might be, at a small level, but you might have, of the 10% rate of return, you might have 2% of it, might be dividends. 8% might be capital gains. Dividends taxed at a lower level, you might pay a fraction of the tax on that second route. So we need to be careful, especially with those long-term investments with non-qualified accounts. And, usually in the context of a financial plan, if you have several types of accounts, if we think about, say, a traditional IRA or traditional 401k, Roth IRA, Roth 401k, non-qualified accounts, oftentimes if we've got multiple types of accounts, we can actually structure that non-qualified set of resources to invest mainly in stocks and in municipal bonds so that we can manage the tax situation better there.
Right. So Spencer, when we think about having conversations with our barber about their rate of return versus my rate of return, I'm stuck in a chair, I've got to talk to them.
Yeah.
How do we approach this idea of tax efficiency? Because even if you're just accruing those dividends and you're not taking them out of the non-qualified account, you still got to pay them from somewhere, whether it's increasing your level of withholdings, whether it is paying out of cash in estimated quarterly payments. How do we think about that rate of return in those types of conversations?
Well, this is where we really have to do all of this in a context of a financial plan. We need to look at the tax return and how much we're paying in tax on these investments and their gains and look at everything together. It's so easy to get in a conversation and start swapping stories and comparing notes, and you're not comparing apples to apples. And, we have this fear of missing out that is internal to us. And can be kind of stoked by certain types of people that tend to be garrulous. But what we need to do is bring everything back to the financial plan, look at it in context. This is where we've got to do tax planning with our investments and make sure that everything's lined up as it should be, because oftentimes, if we actually look at everything together, we say, okay, well, this is actually the best possible set of investments given my goals, desires, and tax situation. But it might not seem like that when we hear someone talking about, rolling the dice with cryptocurrency or something else like that.
Yeah. So as you can kind of tell, all of these situations, it really varies. But the reality is the rate of return is going to be driven by what type of investment it is, where it's held. Is it in a non-qualified account? Is it in a qualified account? And what are the goals that I'm trying to seek here? Is it long-term rate of return over the next 30 years? Is it distributions for the next 5? We can't just talk to our peers and say, well, I got this, you got that, the news media said I should have gotten this. It's all going to be somewhere in the middle because every individual investor's goals are different. And so as you talk about rates of return, feel free to leave questions or comments down below. Clients, we would love to help you understand where your rate of return comes from, why it might be higher or lower than you expect. With that, we look forward to seeing you again next time. If you like these financial planning videos, please share it with a friend. And if you have questions, go to our website at SiriusRetirement.com. This content was provided by Retirement Planning Services. We are located in Knoxville, Tennessee. You can visit our website at SiriusRetirement.com. The information in this recording is intended for general educational and informational purposes only and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents. Advisory services offered through Retirement Planning Services, LLC.